Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the simple moving average, the SMA, the simple moving average crossover strategy. A powerful technique that has been a game changer for many traders, offering a clear and efficient way to identify potential market trends and entry points. Whether you're a beginner looking to understand the basics or an experienced trader seeking to refine your strategy, this video will provide valuable insight into the simple moving average crossover to enhance your trading decision. So stay tuned until the end of this video to learn how to implement this strategy step by step and potentially improve your trading results. So we have to look at a step by step process on how we can implement this strategy using the simple moving average crossover. We start by choosing the simple moving average we'll be using. We'll select two simple moving average for our crossover strategy. A popular combination is the 50-day moving average and the 200-day moving average. So you set your 50-day moving average with your 200-day simple moving average. The 50-day simple moving average is represented by a short-term trend, while the 200-day moving average reflects the longer-term trend. As you can see from my chart, we apply this simple moving average to our chart, and I'm applying it to the GBP USD 4-hour chart. After you have added these two simple moving average to your Forex chart, most trading platforms allow to easily overlay these indicators on your price chart. The third step is to identify the crossover. You have to watch out for the crossover between your chosen simple moving averages. A golden crossover occurs when the short-term moving average, which is this blue line, crosses above the long-term moving average. So when the short-term moving average crosses above the long-term moving average, this signifies a golden cross, which signifies potential or indicates potential bullish trend. Conversely, a death cross occurs when the short-term moving average crosses below the long-term moving average, when the blue line crosses below the yellow line. This indicates a downtrend with the short-term SMA below the long-term SMA. Now, how do we enter a trade? We enter a trade for a long position. We enter the moment we see our short-term moving average cross above our long-term moving average. This is where we would want to enter a long position. Now, to enter a short position, you enter when the short-term moving average, which is this blue line, crosses below the long-term moving average. Both are sloping downward. Remember, price has to be below this moving average to be sure that you are really in a downtrend. Now, when you enter the position at that area, when price crosses over, you will set your stop loss just above this recent swing high. In terms of a selling trade, you set it above the recent swing high. This is where you set your stop loss. Now, in terms of a buy trade, you will set your, when you enter the moment you see your crossover, you set your stop loss just below the previous swing low. This is where you set your stop loss. This helps us to protect our capital in case the trend decides to reverse against us unexpectedly. Now, we need to know how to manage our trade, and as the trend progresses, consider moving your stop loss to take profit to profit level. You take your stop loss from where it is. Once the price moves in your direction, you take your profit, you take your stop loss and put it above your entries to lock in profits. This is how you manage your trade. You might use the long-term simple moving average as a trailing stop in case you would want to use a trailing stop method. You can also exit your trade if price close beyond this point if price decides to close beyond the long-term moving average. Remember, you set your take profit to at least 1:2 risk to reward ratio. This is where you set your take profit to a minimum of 1:2 risk to reward in terms of a buy trade. Now, in terms of a selling trade, you set your take profit to at least 1:2 risk to reward ratio, or you can make use of a trading stop by putting your stop loss above profit when price keep moving in your direction. Remember, you can also exit your trade when you see another crossover. In case you want to remain in the trade using a trailing stop, you can exit your trade the moment you see a crossover between the long-term moving average and a short-term moving average. This will signal for you to leave your trade. Now, in case you want to capitalize on this trading opportunity, you can also wait for price to come back to the moving average to retest. When price comes back and retests the long term or the short term moving average, this can be a good entry point for you to enter the trade. But you enter once you see your candlestick pattern. You can see our morning star, or you see a bearish engulfing pattern that signals for you to enter the trade. Remember, your stop loss should always be above your long term moving average, which is your 200 moving average. Then you go for a minimum risk to reward of 1:2 or 1:3, as the case may be. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video. Happy trading!